So for the markets, let's begin with the top story, shall we? Investors forming a better picture, perhaps, of the state of the global economy.
China,
Europe, the US.
China's forming a bumpy bottom.
close to recovery.
Data is very encouraging.
Very encouraging.
Pretty encouraging.
Yeah, we're talking about China stabilization.
Stabilization.
I don't know who wasn't ever talking about China stabilization.
That's pretty much in the data.
That's baked in the cake, baby.
Europe, obviously, as we all know, has many existential issues.
Structural hurdles.
Structural problems in Europe.
Too many to name.
It's disappointed this year. It's been worse than people expected.
Some pretty weak data.
So woeful over recent months. The U.S. economy is doing well.
A strong U.S. economy.
Strong fundamentals will shine through.
U.S. is not doing poorly.
The U.S. economy may be kind of stuck here a little bit for the next 2 or 3 quarters.
Joining us around the table here in New York is Tony Rodriguez, Nuveen head of fixed income strategy, Jack Caffrey, JPMorgan Private Bank equity portfolio manager, and Julian Emanuel, BTIG equity and derivative strategist. Tony, I want to begin with you. For the global economy this week, the US strong, China getting better, and Europe still the weak spot. Your thoughts?
Well, my thoughts are, like with the retail sales today, we always say that with the U.S. consumer, it's in good shape because of jobs, because of wages, and never underestimate the willingness of a consumer in the U.S. to buy things they don't need with money they don't have. The big problem will be Europe being able to get off the ground, and I think that's going to be not a 2019 event. 2020, possibly you'll see some strength there. China, I think, stabilizing in response to all of the policy measures they've taken, and that's going to be a good sign for the U.S. to be able to stay above 2%.
What do you think, Julian?
Well, it just shows you that really the majority of the threat is external rather than internal. And, you know, and it makes sense given how much of the ecosystem the U.S. is self-contained. And as you mentioned, you know, the consumer has been the driver of this entire 10-year bull market, and we expect that to continue.
And the US consumer, Jack, is looking pretty strong. This data, initial jobless claims, I know we've become increasingly desensitized to how good these numbers are. But let's emphasize the fact that they are fantastic initial jobless claim numbers.
Multi-decade lows, multi-decade improvements in job creation, and we're actually seeing consistent wage gains, and consistent but not so consistent and not so high that we really have to worry about the Federal Reserve changing their policy again, at least over the next 6 to 12 months.